Having been an investment banker for over 30 years, I want to give you my personal perspective on mergers and acquisitions. The big challenge is, how on earth do you teach something like mergers and acquisitions? Because it is such a complex subject, a complex process. It's something which has not really ever been written down in a textbook. And the simple answer is you can only really teach it from experience. So you want to know that the person who's sharing their experience with you has actually been there, done it, got the t-shirt, as it were. It's all well and good having spent a couple of years in an investment bank as an analyst, but then you're really a sort of a voyeur of the process. You're not actually doing it. You're not the senior director running the process and making the decisions. There is no shortcut to actually gaining this expertise. You do actually have to work on deals and you have to have that experience. But having done this for 30 years, I'm now in my mid-50s, I really love sharing this experience with you. And I also want to give you my perspective on what it's like to be involved in mergers and acquisitions. I suppose the starting point really is the business cycle. If you think that every business has a life cycle to it, the whole market is full of these companies, all of which have got their own life cycles. And essentially, it's about creating value. Entrepreneurs create businesses, and they create businesses because they want to build something and they want to make money. These businesses need to grow. In order to grow, they need capital, and sometimes they need to make acquisitions. And then at the end of the day, the entrepreneurs are going to need some form of exit, whether it's partial, maybe it's an IPO and they sell some of their stake and still retain an interest, or a complete exit and they sell the company to somebody else. But without that, they can't realize value for themselves. So you've got a system here where the entrepreneurs are busy creating businesses, but they need access to capital, and ultimately they need to be able to extract capital. And that's really where mergers and acquisitions comes in. So if you start with a company life cycle, you've got a startup, and the startup invents a product and designs it and does all the R&D, and then it goes and finds a customer. Now, if one customer buys a product, that's not really proof. If lots of customers buys a product, then you've got a market. So the company is now growing. Now, in these early stages, they need access to capital. So capital has to be put in. It's very difficult to bootstrap a company from absolute ground zero with no external capital whatsoever. Once the business is established, it's got a group of customers, it needs to grow and it needs to scale that business. And again, if you grow a business, then what happens before you actually get cash in is actually it sucks cash in, because you have to buy materials, you have to pay people, and you have to do all this before you can sell a product or a service to get the money back. So it needs working capital. Now, at some point, it needs to consider how it's going to exit, how the entrepreneurs, the shareholders, are going to achieve an exit. And that could be through a sale, an IPO, or a buyout. And as part of the growth process, they may need to make an acquisition. The company may merge with another company. So mergers and acquisitions sort of covers everything, but it also includes a company sale, because you can have an acquisition, but the other side of an acquisition is the sales side. And I'll come on to explaining that as well. So mergers and acquisitions includes company exits as well. IPOs are a different expertise. That's where you have to have a lot of detailed knowledge about the listing rules in your market, and you have to be able to go through all the process and the documentation of doing that. I've done listings in the London market, but not probably for about 20 years. But that is a different skill, and that's normally handled. All the detailed work on that is handled by a stockbroker rather than an investment banker. So what are the key steps as an advisor? Well, basically, you need to give the company strategic advice. You need to get on board and understand what they're trying to achieve, and then be able to advise them from your experience of the market and the sector about what they want to do. Inevitably, they will want to raise capital at some stage. Now that might be through an IPO, but it's in the early stages, it's much more likely to be through private or institutional, i.e. private equity venture capital investors. The company may well wish or need to make acquisitions. So you'll have to help them on the buy side to find companies to buy and then organize all that and get the funding for it. And then from a sale perspective, you have to help them to realize their investment. And that might be through a complete exit or by working with a stockbroker to achieve an IPO. Now, let's look at some of the market players in the M&A ecosystem. And I'm not really going to focus here on the companies. Obviously, the companies are at the core of the ecosystem. But from the advisory perspective, from the perspective of the M&A players who are making the process happen, you've got the investment banks who may or may not have an equity stockbroking function inside them. In the old days, these two functions were separate, really from the late 80s onwards, which may seem like history to you, but it's not to me. Then these became very much more integrated. So you have the investment banks, you have accounting and auditing firms who really handle the financial due diligence and the accounting side of the deals. You have the lawyers who handle the legal due diligence and the documentation of the deals. And then you have the consulting firms who may or may not be involved. The larger the client company, the more likelihood they will be involved. They're very useful from a strategic point of view, from a due diligence point of view, and also from an international point of view, because very often they have international offices. If you're an investment banking advisor, you really need to have a sector focus. It's too wide a market, unless you're operating really at the tiny end, to be a generalist these days. That's my firm view. So I concentrate on the tech sector. So you need to understand the sector, who the players are, what the different subsectors are, how the sector is structured and organized, what the trends are, what is driving the growth of the sector, what technologies are new, what regulations are coming in, who are the major players, what is hot, what do people want to invest in. And then you need to have a very good grasp on how you value companies in the sector. And different sectors have different metrics and different, sometimes different techniques, because the way of valuing a property company is very different from valuing a tech startup. Let's look at the sector focus in a bit more detail. You need to understand the landscape and the business ecosystem. So who are the players in the market? You need to know who the market leaders are. You need to know which are the growth companies, who are the disruptors, and frankly, who are the targets? Who are the companies that are going to be able to be seen as acquisition targets for your clients? And of course, you can put any company that's owned by a private equity firm or a VC firm on that list. You need to know the ownership of companies. Public companies are very easy, but identifying private companies, depending on which geographic market you're in, US and UK relatively easy, in some European markets more difficult, information is more tightly held. You also need to know who are all the venture capital and private equity players in the market and which companies they own and when they bought them and therefore when they're likely to exit from them. Then you need to have some understanding of the strategies of the companies in the market. Are they acquirers or consolidators? Are they growth companies or are they targets? And you need only to look at their recent history to see which of these groups they fall into. If you're an advisor, you also need to have a good idea of the deal history in the sector. Who has done what in the past? And it's by watching who's doing what to whom, then you can start to identify possible opportunities from an advisory perspective. But it is a complex picture because there are companies who are raising money all the time. There are companies that are being started all the time. There are companies who are making acquisitions all the time. And there are companies who are exiting all the time. And if a company goes from a private company to a public company through an IPO, well, now it's got paper, which is publicly listed, that they can use for acquisitions. So they in a sense, they've achieved an exit, but they've metamorphosed into a type of company that they can now go on and become an acquisition client. You need to understand who's funding the businesses, because you need to know that the businesses are fundable. you also need to have a good national stroke international perspective, because it's no longer good enough just to understand what's going on in your market. You need to know which companies are coming in from overseas to enter your market, or you need to have a perspective on the companies in your market who want to go overseas, and ideally you help them with both. As an advisor, what is the key question? Well, the key question is, why should they hire you? And you have the IBM issue stroke dilemma here, because nobody ever got fired for buying from IBM. So there's a tendency for clients to rush to the big bulge bracket firms who may or may not take them on. But in a sense, if you're not in a very big firm, then you have to be able to carve out your competitive position very clearly to demonstrate why they should be hiring you. So you need a track record. You need to have done deals. You need to be able to demonstrate your expertise, both in the M&A process, but also in the sector. You need the ability to originate deals. You need to be able to think and come up with good ideas about companies that could be acquired for your client. And of course, you need to be very clear about how you're going to be paid. Whether you take a retainer, whether you work on a success fee only, whether you get paid for stages, whatever it is. But you need to be very clear what your terms and conditions of business are. So if you then take that position and say, well, okay, I've got to identify potential clients. So I'm now the investment banking advisor, and I'm thinking about my own marketing for my own business. So I need to be able to identify the buyers. I need to have relationships and contacts with the sellers. I need to know all the key financial investors in my sector. You need to know who is doing deals, who has the money, which companies have got the money to do deals. And critically, you need to build relationships with the decision makers. So let's talk about some of the outline skills then. Clearly, you need to have a good understanding of the M&A process. And you need to differentiate in that between the buy side and the sell side. So if you're on the buy side, you're acting for a client who wants to make an acquisition. If you're on the sell side, you're acting for a client who wants to sell his company on the other side of that acquisition. You need to be able to pitch. You need to be able to go out and market and pitch yourself and persuade a client to hire you. And you need to have very clear terms of engagement for your client, and that's normally in the form of a detailed engagement letter, which can run to several pages and often several pages of additional appendices with boilerplate stuff on them. So you need to be able to present yourself and your terms and conditions very clearly. Let's talk now about buy-side processes. Essentially, I've now been hired by a client to make an acquisition for that client. So the first thing I need to do is to review the sector and identify targets for that client. Those targets have to be available. It's all well and good having a paper exercise identifying a long list of targets, but unless you actually know that the board of that company are prepared to contemplate a sale now, it's no good talking to them now if they're talking about a sale in 2 years' time. And then you need to be able to make an approach on behalf of your client to see if they're prepared to have a discussion. That leads, logically enough, to initial discussions between the parties, which at first may or may not involve your client and or the disclosure of their name. You may do that on a no-names basis to start with. You'll need to come to some view and then agreement on value and valuation. So you'll need, as the advisor, to value the company, and then you'll need to share that view with your client, and then we'll pitch that value as part of the acquisition price to the target company. That leads inevitably to negotiations. That leads to the tabling of a letter of intent, which sets out the key terms which are negotiated and then agreed. Once that letter of intent is agreed, there's a phase of due diligence where you send in the lawyers and the accountants, the management consultants, anybody else you want to do on environmental, health, HR, whatever it is, to go and check that everything is right. There are no skeletons hiding in the cupboard of the company you want to buy. And then finally, you get everything sorted out, you finalize the terms, you draw up a sale and purchase contract, and then you agree the deal. On the sell side, it's a slightly different process. The last part of it mirrors the first part, but from a sell side, you need to go and pitch to the client, and persuade them that you are competent to handle the sale of their business. So you'll need to give them an idea from your perspective of the valuation and the key exit conditions that you think will suit their business. And you'll also want to know from them what their key exit conditions are. Do the management want to stay? Do they want to go, for instance? You'll need to identify the universe of potential acquirers, have an understanding of their strategy and the rationale. What you're looking for is the acquirer who wants to pay a strategic premium for your client, and therefore you achieve a higher price on the exit than you otherwise would have done. You'll need to put together the data room. This is the data room that is used in the due diligence process, and it's quite a complex collection of business documentation, which will be overseen by accountants, but at the end of the day, you are ultimately responsible as the investment banking advisor to make sure it's put together. Then you'll need to market the business. You might do this as a rifle shot, only approaching one or two potential buyers, or you might run a wide-ranging auction and approach a whole wide range of potential buyers. Maybe initially on a no-names basis, maybe initially only with a 1 or 2 page teaser about the deal, but you will then need an information memorandum on the company as part of your marketing materials to then, once the potential buyer has indicated interest, they've signed a letter of confidentiality, and then you provide them with the information memorandum, which is probably a 30 or 40 page book about the business, which helps them to form a view as to whether they want to make an offer. There'll be some negotiation and discussions, and then you receive an offer or offers, ideally. Those offers need to be negotiated and ultimately heads of terms agreed with one buyer. You may be negotiating several heads of terms at the same time, but you then really only want to sign up with one. That then leads to due diligence. That leads to final documentation, sale of purchase contract, closing, and the money changes hands. So that is the other side of the deal. As an advisor, as an investment banker in this process, well, you need a lot of skill. This is not something which is an Airfix kit construction. It is a very complex process, and it depends on a lot of experience. You need to have a network and relationships across your sector and across all the financial investors, and probably into other investment banks as well. You need a track record, and you need to be able to demonstrate your integrity, because confidentiality and trust is so important. You need to be able to pitch your business and your abilities and sell yourself to clients. You need to know how to market their businesses to other potential buyers in the market. So you need marketing skills as well. You need to master and understand all the documentation involved. You may not write a lot of it, but you'll certainly want to be able to advise on whether the phrasing and the weight of paragraphs and content of detailed documents are right and are in your client's favour. This is something which you can only really gain from experience. You then need to be well organised and be able to manage the deal process, because that's your primary role, is taking it all the way through. And that means following up on meetings, organising agendas, making sure that action steps are taken, making sure that the process follows the timetable that you set out. And of course, you need negotiation skills, because you are the lead negotiator for your client, and you need to advise them on the best way to negotiate the deal and to get the deal closed. So that's my personal perspective on mergers and acquisitions. It's based on over 30 years of experience. I know this has been quite a long lecture, but I want to share that personal experience with you to give you the confidence that I have that detailed understanding of the mergers and acquisitions process, which I'm trying to share with you.
Yeah!